Welcome to the Techno Fundamental Report for May the 18th. What is FOMO? Fear of missing out. This is Paul Tudor Jones. We'll talk a little bit more about him in the video, but he basically says don't be a hero, don't have an ego, always question yourself and your ability. Don't feel that you are very good. The second you do, you are dead. So basically, slow down, realize that the market is starting to show signs of improvement. Not a lot, but we are seeing some signs that things are starting to turn. Now realize this has been a terrible bear market. It started, in our opinion, around February of 21. And if you remember, 22 was the worst year for the market since '08. And it was the fourth worst year since 1945. So it was a difficult year. It was a difficult year for bonds. Bonds had their worst year ever. So my advice is that as you see opportunities arising, move slow. Don't do a cannonball into the pool. You want to move slow. You want to sit on the side of the pool, think about what you're doing. Let the market pull you in. Don't push. Let it pull you. And the way we would do that is we would start with a opportunity. We would find, let's say, a stock. We would buy a very small position. Then if the market, Mr. Market, allows us to make a few dollars or make some money in the stock, then we can add another one and keep it small, keep it slow. Now, I continue to refer to the battle for investment survival. This bear market, it's a battle. There's no getting around it. But one thing that Loeb says in the book, he says accepting losses is the most important single investment device to ensure the safety of capital. In other words, if you've made a mistake, you need to clip it quick. You need to get out of it quickly. Don't let something just deteriorate and deteriorate and deteriorate. So keeping losses small but let your winners run is key. Now, you know, Eisenhower and Patton were interesting history figures because they had strategies. They had to do what they had to do. It was like they were elephant hunting. They were going after World War II to win World War II. So what Loeb also says is that you need to go elephant hunting, because if you settle down and just want to find low risk types of things, you're probably going to lose your money, is the bottom line to that. Now here kind of is an example. And I also want to make a point about fads and hype. And right now, the thing to realize is that with the TV set and the internet, there's so much hype out there, it's unbelievable. But I remember back when everybody was saying, hey, we were going to get rich in the marijuana stocks. Well, this is Canopy Growth. This was the main marijuana stock. Goodness gracious, that's been one disaster, one major disaster. So this was really hyped back, you know, in 21, but it just turned out to be a disaster. Now, back to Paul Tudor Jones. He says the Fed is done raising rates, stocks to finish the year higher from here. Well, maybe he's right, but it does confirm our power index. Now remember, the power index is where we're measuring the rate of change of the yield on the 5-year Treasury over 125 trading days, which is roughly 6 months. So you can see here we crossed below the zero line here back around the banking crisis. So what it was telling us is the Fed is probably done. And Paul Tudor Jones, I'll tell you why he's famous. He's a hedge fund manager. He was famous back in '87. And by the way, we were using the power index back in '87, and it gave the same basic signal. In other words, when it crosses back above zero, it's telling you the Fed's going to start raising rates. So Paul Tudor Jones became famous because he predicted the 1987 crash and saved people a lot of grief. Now, I did want to point out a couple of things here. This is the NASDAQ. This is the NASDAQ advanced decline line. In other words, advancers versus decliners. You can see it's really been in a downtrend. However, the index is in an uptrend. What it is that the NASDAQ is being driven by just a few stocks. So you can see it also here. This is new lows minus, this is new highs minus new lows. So as I look at the market, I would say that this drop that we've seen over the last 2 years has been quite dramatic. I mean, go back here and look at the drop in '08. It was bad, but this has really been quite troubling here. So what I would really like to see would be the new highs minus new lows turn up. We need to see a turn up here. Now, I'm going to go through some indexes here. You need to look at more than the Dow Jones Industrial Average. Remember, the Dow Jones is 30 industrial cyclical companies. And if you're going to look under the hood, you need to look at 5 indexes. So here's the NASDAQ. As you can see, really rallying, making a new 52-week high, looking very good. However, like I say, it's just a few stocks. Now, here's the mid caps. You can see here, here's the banking crisis, pretty much moving sideways, needs to break out. So the mid caps really aren't doing it. The New York Stock Exchange, same thing. Now, there's a lot of bank stocks in this particular index, and you can see it's continuing to have trouble. Here's the small caps. This is really the worst performing index that we're looking at right now. However, we did see a little improvement yesterday, but like I say, you got to get under the hood here. This is not a roaring bull market, but we are seeing improvement in the S&P and the NASDAQ. You can see here S&P holding up well. Now, the really good news for me is the aggression index. The aggression index is designed to tell us if the institutions are moving money out of their aggressive stocks into defensive stocks. So it's a simple ratio, NASDAQ divided by consumer staples, things like toilet paper. Well, this particular indicator peaked back here in February of 21. That's where the bear market started. Then it rallied and it came down. Now, we came down dramatically. Now, we've rallied here in January, stabilized. A breakout above 165 would be quite positive. This is the main positive that I'm seeing right now, is that the NASDAQ is starting to outperform the consumer staples. Now, again, the bank stocks continue to be troubling. This is not looking much better, a little better. We broke down, as you can see here, on these regional banks. But there's an argument out there that there's more going on here than just the regional banks, because the entire financial sector, I'm talking insurance, I'm talking brokerage firms, I'm talking money managers, all these stocks look pretty darn weak. Now, here's our 3 economic indicators. You can see here interest rates continuing to move sideways on the 10-year Treasury. However, it is in a downtrend as we speak. Oil, as well, is in a downtrend below the 200-day moving average, and the financial stocks continue to be in a downtrend as well. So if you have any questions, please let me know. We are starting to see some opportunities, but like I say, don't do a cannonball into the pool. Sit on the side of the pool and just slide in as the market pulls you in. Thank you very much.